These are all of O-Levels economics, section 3 definitions in 5 minutes. Money is an item that is generally acceptable as a means of payment. Commercial banks are banks that aim to make a profit by providing a range of banking services to households and firms. Liquidity is the ability to turn an asset into cash quickly without a loss. Central bank is a government-owned bank that provides banking services to the government and commercial banks and operates monetary policy. Disposable income is income after income tax has been deducted and state benefits have been received. Wealth is a stock of assets, including money held in bank accounts, shares in companies, government bonds, cars, and property. Rate of interest is a charge for borrowing money and a payment for lending money. Average propensity to consume is the proportion of household disposable income that is spent. Consumption is expenditure by households on consumer goods and services. Savings ratio is the proportion of household disposable income that is saved. Average propensity to save is the proportion of household disposable income that is saved. Mortgage is a loan used to help buy a house. Earnings are the total pay received by a worker. Wage rate is a payment that an employer contracts to pay a worker. It is the basic wage a worker receives per unit of time or unit of output. National minimum wage is a minimum rate of wage for an hour's work fixed by the government for the whole economy. Wage differential is the difference in wages. Primary sector covers agriculture, fishing, forestry, mining, and other industries that extract natural resources. Secondary sector covers manufacturing and construction industries. Tertiary sector covers industries that provide services. Elasticity of demand for labour is a measure of the responsiveness of demand for labour to a change in the wage rate. Elasticity of supply of labour is a measure of the responsiveness of the supply of labour to a change in the wage rate. Specialisation is the concentration on particular products or tasks. Division of labour occurs when workers specialise in particular tasks. Trade union is an association that represents the interests of a group of workers. Collective bargaining occurs when representatives of workers negotiate with employers' associations. Real income is income adjusted for inflation. Industrial action is when workers disrupt production to put pressure on employers to agree to their demands. Strike is when a group of workers stops work to put pressure on an employer to agree to their demands. Industry is a group of firms producing the same product. Quaternary sector covers service industries that are knowledge-based. Internal growth is an increase in the size of a firm resulting from enlarging existing plants or opening new ones. External growth is an increase in the size of a firm resulting from merging with or taking over another firm. Horizontal merger is the merger of firms producing the same product and operating at the same stage of production. Vertical merger is the merger of one firm with another firm that either provides an outlet for its products or supplies it with raw materials, components, or products it sells. Conglomerate merger is a merger between firms producing different products. Rationalization is the elimination of unnecessary equipment and plant to make a firm more efficient. Backward vertical merger is a merger with a firm at an earlier stage of the supply chain. Forward vertical merger is a merger with a firm at a later stage of the supply chain. Internal economies of scale are lower long-run average costs resulting from a firm growing in size. External economies of scale are lower long-run average costs resulting from an industry growing in size. Internal diseconomies of scale are higher long-run average costs arising from a firm growing too large. External diseconomies of scale are higher long-run average costs arising from an industry growing too large. Corporation tax is a tax on the profits of a company. Total cost is the total amount that has to be spent on the factors of production used to produce a product. Average total cost is total cost divided by output. Fixed costs are costs that do not change with output in the short run. Average fixed cost is total fixed cost divided by output. Variable costs are costs that change with output. Average variable cost is total variable cost divided by output. Long run is the time period in which all factors of production can be changed and all costs are variable. Price is the amount of money that has to be paid to obtain a product. Total revenue is the total amount of money received from selling a product. Average revenue is total revenue divided by the quantity sold. Profit satisficing is sacrificing some profit to achieve other goals. Profit maximization is making as much profit as possible. Market structure refers to the conditions that exist in a market, including the number of firms. Competitive market is a market with a number of firms that compete with each other. Normal profit is the minimum level of profit required to keep a firm in the industry in the long run. Supernormal profit is profit above the level needed to keep a firm in the market in the long run. Monopoly is a market with a single supplier. Barrier to entry is anything that makes it difficult for a firm to start producing a product. Barrier to exit is anything that makes it difficult for a firm to stop producing a product. Scale of production refers to the size of production units and the methods of production used. Sunk costs are costs that cannot be recovered if a firm leaves the industry. Thanks for watching.